I am up 22% on my trading account this week by following these three very simple rules. Most traders lose money in the market because they don't follow these three simple rules. Trading is one of the most freeing skills that you can develop because what it does is it allows you to generate an income without having to be strapped down to a specific location, without having to have a boss, without having to have clients, without having to have hours. But unfortunately, it's one of the most difficult things for people to do. And the reason is because the psychology behind trading. When you are dealing with money, especially money that you might need for something else at a certain time, you are setting yourself up for a psychological torture that can literally suck the energy and life out of you. Now, I want to tell you guys that I have definitely been in that place. I've gotten to a place when it comes to trading where I have felt like a complete, irresponsible piece of garbage at the lowest of lows. And over time, I've developed three principles. And these three principles, I believe anybody, if they take them and they actually apply them, they can become a successful trader over time. Now, these things are very, very simple, but that does not mean they are easy. It's up to you to take this information and then apply it to your own trading and just watch how over time you start to see your trading transform from taking multiple giant losses to actually becoming a break-even trader and then even a profitable trader. Now, we all know trading can be stressful. It could lead you to, taking a few shots of organic maple syrup. And by the way, make sure to like the video, subscribe to the channel, and click the bell for notifications because we are bringing you the juiciest trading psychology, strategy, and crypto updates here on YouTube. First rule to becoming a profitable trader is to abide by a strategy. You would be so surprised how many traders just start throwing money around, trading based on emotion, chasing price, instead of sticking by some very simple criteria that gets them into a trade. You can go on YouTube right now and you can find videos of people basically taking random trades, flipping a coin, heads they go long, tails they go short, and they do this with good risk management, and over time they actually break even. Sometimes they're even in slight profit without any strategy. So if you know that you can break even by taking random trades, shooting for a 2-to-1 risk-reward ratio, imagine now anything you do that can put the probabilities in your favor, maybe a 60% chance of a win, 70% chance, 80% chance, you are now setting the probabilities up in your favor. And what this also does, if you have a clearly defined strategy, is it allows you to sit out of the markets when things are not in your favor. A lot of times when price moves, people want to take trades willy-nilly, but they don't actually have a set of criteria that's telling them now is the time to take a trade. So what do you need to do? You need to have a strategy or a set of strategies, which are basically multiple things that are telling you now is the time to take a trade. And once you have this strategy, you need to promise yourself that you are only going to take a trade if a setup presents itself that is according to your strategy. Now, this also involves making a plan in advance for taking a trade. For example, I want to talk about this Bitcoin short trade that I am in right now. I had a very specific plan according to a strategy, which was this. We put in our first high at $31,553. My plan and my strategy was the following. If we take that high out and then we wick back down below it with bearish divergences, I would take a short trade. I actually gave this idea in my trading Discord, the Casper Crew VIP Discord. I gave this setup in advance where I was looking to take that short right from $31,550 if we took out that high and then got a rejection. So when that happened, I didn't really have to think twice about entering into the short trade because I waited patiently for my strategy to present itself with a short setup, and it allowed me to take a short from literally the exact high. Now, if you do this, where you know there are certain strategies you are looking to trade, and you promise yourself that you are only ever going to take a trade if one of your strategies presents a setup, you are setting yourself up now for success. Most, I would say all, of my major losses that were losing more than you should be risking per trade happened because I was not sticking to one of my strategies, and I was not sticking to these 3 rules. So I highly recommend, especially if you're newer to trading, learn some basic trading strategies, learn some basic technical analysis, learn about support and resistance, learn about different indicators. It doesn't have to be overcomplicated. Like I said, people can take random trades and break even. So even if you're using a very simple strategy, you're giving yourself an advantage as to anybody who's just chasing price and basing their trades on emotion. The second rule to becoming a profitable trader is abiding by good risk management. What is risk management? Risk management means you have a strategy in place for how much money you are willing to lose per every trade that you take. And in my book, risking more than 1% of your trading account per trade is poor risk management. If you can keep your losses at 1% of your account or less, you are setting yourself up for success. Now, does this mean that you're putting 1% of your account on a trade? If you have $1,000 in an account, does this mean you can only put $10 on a trade? No. You might have $1,000. You might be able to put $2,000 or $3,000 on a trade and still only risk $10. And that comes down to 3 basic things here: your position size, your stop loss, and the risk reward ratio. So let's start with your position size. This is very important. How do you calculate your position size? Well, it goes hand in hand with your stop loss. What a lot of traders don't understand is, let's say we're looking to take a short from resistance here. And we're looking, let's say we see the rejection, so we enter a short trade right here. We put our stop loss above the wick right here, a 0.75% stop loss, and our target is down to support. And let's say that we are shorting again here, and this time we have to put our stop loss above this wick. Now we have a 2% stop loss, and our target is still the same, okay? In both of these trades, it's very important to understand that whether you have the 2% stop loss or the 0.75, let's just make it a 1% stop loss, right? Just for simplicity's sake, we have a 1% stop loss and a 2% stop loss. The amount that you are risking per trade stays the exact same. If you have $1,000 in your account, whether you have a 1% stop loss or a 2% stop loss, if that stop loss gets hit, you should be losing no more than $10, right? Let's throw another example in here as well, just for example's sake, where we have a 0.5% stop loss, right? I want you to notice something about all of these trades. They have different size stop losses, which means if the stop loss gets hit and we're losing $10 per trade, the smaller the stop loss, the more we can put on the trade. If we have a 0.5% stop loss with $1,000 in our account, we can use leverage to put $2,000 on the trade. And if the $2,000 position gets stopped out after a 0.5% move, we have only lost 1%, which is $10. Now, if we have a 1% stop loss with a $1,000 account, now we put the full account on the trade. If we get stopped out, we lose $10. If we are using a 2% stop loss, now we put half the account on the trade. And if half the account gets stopped out after a 2% move to against us, we still are only losing $10. A lot of traders don't understand this. They might put a lot of money on a trade because they think it's going to be a really big move to the downside. What you should do is calculate your position size based on your stop loss, based on your strategy and your plan. If your plan is to short this level when you see the rejection, you have to understand that if this is truly going to be a rejection, if the price comes above the previous high, you're wrong in your idea and you need to get out. So you have a predetermined risk per trade that's based on your strategy. Now, the way you're going to calculate your position size is the following. All right, let's say you have a random stop loss like 1.29%, right? What you're going to do is, let's say that you have an account which is $1,000 and you want to risk $10, which is 1% of your account, right? What you're going to do is you're going to take the amount that you're willing to risk, in this case is $10, and you're going to divide that by the percent of your stop loss. So if it's a 1.29% stop loss, you're going to divide that by 0.0129, and that will give you your position size in dollars that you put on that trade. Now, if you abide by this, and of course you have to calculate for fees on your exchange, every single trade you take will have the same amount of risk, which means if you get stopped out, you're only losing 1%. Now, this is where risk-reward ratio comes in. Notice this. If you have a smaller stop loss, you can put more on the trade. Now, when you hover over this short position right over here, where we've got the short tool, right, the short position tool in prediction and measurement tools here, forecasting and measurement, when you hover over this, it's going to give you a risk-reward ratio, in this case 9.34. What does that mean? That means in this potential trade setup, you are making 9 times more reward than the risk. This means if you're risking 1% of your account, you're potentially going to make 9% on your trade, right? This one trade has the potential to make you 9% on your whole account while risking 1%. This is very important because if you are taking trades where your target is very, very low, let's say right here, right, and your stop loss is the same as your take profit, this is not a good risk management tool. You want to always aim for having the target more than the stop loss. Why? Because let's say you take 5, 6, 7 losses in a row. 7 losses in a row on these types of trade setups will lose you 7% of your total trading account. Now, on the 8th trade, you make 9%. That's about break even, probably even a small profit, right? After the 7% loss, right? And then you make 9% on, I guess 93% of your starting capital, you're probably about a break even, right? You can lose a lot of trades. You could be wrong a lot and still break even, right? And even the bigger your stop loss, the worse of the risk reward. So if we need a 0.5% stop, this trade is a 9 times more reward than risk. If we need a 1% stop, it's 4 times more reward than risk, still really good. A 2% stop loss, still 4 times more reward than risk, depending on how we set up this trade, right? Actually, hang on. That's not 2%. This is 2%. It's still 2.3 times more reward than risk. So what we need to do is we need to calculate our position size based on our stop loss, based on our strategy, using this formula right here. And then we need to make sure that we are always looking for trades where the target is more than the stop loss. I recommend at least 2-to-1 risk rewards. I actually personally don't go for less than 3-to-1 more reward than risk. This is so important. If traders can get this down, people will at the very least not blow their account. Because even if you're wrong most of the time, if you're shooting for 3-to-1, 4-to-1 risk reward ratio trade setups, only risking 1% of your account, you're not going to blow that whole account. You might lose money if you really suck, but you're not going to blow that account. This is going to keep you in the game so that you can keep practicing and learning and getting better and better over time. Make sure to like, subscribe, click the bell for notifications, leave a comment down below. Let me know if you find this video useful. The third rule is going to have its own separate video. So make sure to come back tomorrow and watch the next episode of this little series here, because this is going to be the pin that holds everything we just talked about together. So with that being said, God bless everybody in the name of Yeshua, Jesus, the Messiah. Even if you are not religious, I still pray you and your family are super blessed. And I will see everybody in the next video. Peace.